Okay, guys, to piggyback off the notes I just gave you, we're going to take a look inside my Fidelity trading account to look at an order entry screen. Okay, I've scrolled down to the bottom so you can't see my account information up top. So it does look a little bit off, but this is the most important part over here. So the first thing you type in is a symbol. Okay, depending on what you're looking at, again, it could be an ETF, could be a single stock. But after that, we've decided what security we're going to acquire. We can either select buy, okay, self-explanatory, sell. We could sell shares short if we're betting against it. If we've already bet against it, we can actually buy in order to cover. Or if we've just given up and can't take the pain anymore, we can click sell all shares. Okay. If we are not doing sell all shares, let's say we're doing a buy, we're going to need to enter the number of shares here. How many are we looking to acquire? Now, in order types, the first type of order that will come up is a market order. And that just means I don't care what the price is. I want to buy it and make sure that the order is completely filled. I want 100 shares at whatever price is available. Okay, this is not exactly a great uh, way to buy if you're trading a very thin stock, okay, a stock that doesn't trade much in a given day. If you're trading a company like Intel, which trades millions of shares per day, it's probably not a bad way to fill your order. Okay, the way I prefer to is a limit order. Okay, limit orders, I can put them in at any time of night, like 11:34 p.m. I put in most of my orders the night before, and then during the trading day, I'll get my alerts to see if they've executed. I get to decide the exact price I'm willing to buy at or the exact price I'm willing to sell at. Typically, if I'm looking to buy, I put something, anywhere from 5 to 7% below what the market is today, and hopefully something happens. Maybe the whole market right now being very volatile. I'm getting a lot of orders. On Monday, I got all five of my orders executed, and I sold all five of those positions today. Um, it just, we got lucky. So we had a horrible day on Monday, fantastic day on Tuesday. I can't walk away from profits like that. So I build cash for the next down day, which is sure to come. Okay, so I get to decide exactly where we're looking to buy. Now, stop loss is something. If I already own something and I put in a predetermined price to sell in case of a worst case scenario. So let's say I bought it at 20 and I'm not willing to let it go below 18. So I'd put in a stop loss at 18, and that would be a market sell to close the position once the price of 18 was executed. Okay. Now, a stop limit is not as safe. Okay. A stop limit means I bought it at 20. If the price ever goes to my stop limit of 18, it puts a limit order to sell at 18. Now, depending on how bad things are, it might execute at that price, it might not. So if you want to guarantee your sale, do the stop loss, not the stop limit. Now, you can put in trailing stops. Trailing stops are something that we put in is if I've bought it at 20 and all of a sudden it went up to 24, I can put in a stop loss at about 22 so I can guarantee my profits. I can say always keep the trailing stop at $2 below, let's say, the last price that was quoted, or $2 below the bid. Now I can do a dollar amount or I can do a percentage amount. Okay, so I have choices and to do the stop loss. And again, that's a trailing stop loss. So once that price triggers or that percent triggers, it's a market order to sell. Now you can do a trailing stop limit based off dollar amount or a trailing stop limit based off of percent. Okay, now once that percent or dollar amount triggers, it puts in a limit order to sell, and that may or may not execute. Okay, after we've decided how we're going about buying or selling, you get to declare how you want this to work out. A day order, typically that's what I do. I decide each night what orders I'm willing to buy at or sell at for the next day. And then if they don't execute, they're canceled at the end of the day. Now, good till canceled means I can pick the exact date and time that that order will stay on the books for. Okay, it could stay on for a year, it could stay on for 2 years, it could stay on for 20 minutes, depending on what you want. Now, fill or kill means we get the whole order or we don't want it. Okay. Immediate or cancel, I want this thing within a very short amount of time. And if I don't get it, then I want to cancel the order. On the open means we want to buy, but only in the beginning of the trading day within the first few minutes. On the close within the last few minutes of the trading day. I don't usually like to trade on the open or on the close. If I do, I'm putting limit orders really far outside the market. There's a lot of fear and volatility when the market opens or closes. So many times you can get an outlandish buy or sell in the morning, but I don't usually like to trade right off the open or right off the close. So my typical would be the day order. I'm putting this limit order for the day. If it doesn't execute at the price I wanted for that day, the trade is canceled. Okay. Now, the last thing that we decide on is what do we want to do? Do we want to risk cash in our account? So if I'm buying and I'm buying with $1,000 that I have in the account, that's all I can lose. Or am I so sure of this bet that I'm willing to borrow someone else's money in order to increase my returns on that investment? Okay, so this is our order screen, and hopefully this order screen goes a little bit further at explaining the notes from the previous section.